Hey everyone, and welcome. So, it's that time again, right? You're looking at your tax numbers for the year that just ended, and you're probably thinking, well, the ship has sailed for 2025. But I've got some fantastic news for you. Today, we're going to dive into some really powerful, kind of surprising last-minute strategies you can use right now to lower that tax bill.
So let's just get right to it. Is it all over? Is your 2025 tax bill just set in stone? It's what most people think, but the answer is a huge, emphatic no. Seriously, there are still some key moves you can make before you file, so let's jump right in.
That's right, it is not too late. The first thing we're going to look at are these powerful accounts that you can still put money into for 2025, even though, we're already in 2026. This is where you can make some of the biggest dents in what you owe the IRS.
Okay, first up, retirement accounts. The calendar might say 2026, but the IRS, thankfully, gives you a little grace period. You have until the tax filing deadline, which is usually April 15th, to make a contribution and have it count for last year, for 2025. So you've got a choice to make here. For most of us with earned income, a traditional IRA is just a fantastic option. I mean, every single dollar you put in can directly lower your taxable income. But if you're self-employed, you got to look at the SEP IRA. It's a total game changer because it lets you contribute way more. The key is just picking the right tool for your situation.
And here's another incredible tool that works the exact same way: the Health Savings Account, or HSA. If you had a high-deductible health plan last year, in 2025, you can still put money into your HSA for that year, right up until the tax deadline. And this is why people go crazy for HSAs. They have what's called a triple tax advantage. It's amazing. The money goes in tax-free, which lowers your bill right now. Then, it grows completely tax-free, and when you pull it out for qualified medical costs, it comes out, yep, you guessed it, tax-free. It's honestly one of the most powerful tax-saving accounts that exists. Okay, so we've covered what you can still do. Now, let's switch gears a little bit. Let's talk about maximizing the benefit from stuff you already did in 2025. This is all about making sure you get every bit of credit for the smart moves you already made. If you sold some investments at a loss last year, I know, it stings, but don't let that pain go to waste. You can use it. It's a strategy called tax loss harvesting. First, you use those losses to completely wipe out any investment gains you had. And if you have more losses than gains, you can use up to $3,000 of that to lower your regular income. That's a huge deal.
And of course, your generosity can pay off too. Make sure you're claiming every single donation you have a receipt for. And think beyond just cash. Donating stock that's gone up in value is an awesome strategy because you get the deduction and you might get to completely avoid the capital gains tax. And for anyone over 70.5, doing a qualified charitable distribution straight from an IRA is just an incredibly smart, efficient way to give.
All right, let's talk about deductions. You know, these are all the little, and sometimes big, expenses you can subtract from your income to lower how much you're taxed on. And believe me, there are some really common ones that people miss all the time.
Okay, this is a really big decision point for everybody. Most people just take the standard deduction. It's the easy path, it's simple. But if you had a lot of expenses last year, we're talking high mortgage interest, state taxes, big medical bills, or those charitable gifts, it is absolutely worth it to take 5 minutes and add them up. If your total is higher than the standard amount you itemize, you'll save money. It really is that simple.
Now, for all my self-employed people out there, listen up. There is a whole world of deductions available just for you. Your home office, your business mileage, even part of your internet bill. But pay special attention to that last one, health insurance premiums. This is a special perk for the self-employed. You can deduct what you paid even if you don't itemize. Do not leave that money on the table.
We've talked a lot about deductions, and they're great. But now, we're moving on to their superstar cousin, tax credits. And let me tell you, these are even better. Why? Because they are a straight-up, dollar-for-dollar win against your final tax bill.
So what is the big difference here? Well, a deduction just lowers the amount of your income that gets taxed. A credit, on the other hand, directly reduces the amount of tax you actually owe. Think of it like a gift card versus a coupon. A $1,000 deduction might save you $240, but a $1,000 tax credit, that saves you the full $1,000. It's a direct discount.
And some of these credits are huge. I mean, for example, if you or your kid paid for college tuition in 2025, you might qualify for the American Opportunity Credit. That can be worth up to $2,500. It's one of the most valuable credits out there, and you absolutely have to check if you had any education expenses.
We are in the home stretch now.
You've got all your info together, you've figured out your strategies, but before you hit that file button, let's just do one final sanity check to make sure you've squeezed out every single dollar of savings you can. 2 really quick things to double-check. First, your filing status. Now, almost all married couples file jointly, but there are a few very specific situations where filing separately could actually save you money. It's worth a quick look. Second, don't get so focused on your federal return that you forget your state taxes. States have their own unique rules, their own deductions, their own credits. Don't miss out.
Look, if you only take one piece of advice from everything we've talked about, please let it be this. Modern tax software makes it so easy to play what if. Run your numbers and then ask, okay, what happens if I put another grand in my IRA? Or what if I itemize instead? Just see what actually moves the needle. A few extra minutes playing with these scenarios could literally save you hundreds of dollars.
So there you have it. The main takeaway here is that you have way more power over your tax bill than you think, even after the year is over. And that kind of brings us to a final thought looking forward. What's just one small change you can make this week? Maybe it's automating a retirement contribution or getting a better app to track your mileage. What's one thing you can do now to set yourself up for an even better tax outcome next year? Taking that little step can make all the difference. Thanks for joining me.